Morning, Tanya. Good
Good morning.
morning, Sabrina. Got that out of the way. Hey, good morning, Fatima. Rates are being brutalized this last couple of weeks, huh?
Yes.
Yes. Oh man, tough. All right, I'm gonna start recording, and we will start here. Perfect. Good morning, good morning, good morning. I hope you all had a great week last week. I hope you all had a great weekend. I was out of town from Tuesday and got back late last night, and I was up at 5 a.m. Trying to catch up, right, for work from last week. But I kind of want to talk to you about what I was out of town for. And some of you guys already know, more or less, right? NAREB, National Association of Real Estate Brokers, had their annual convention, their 76th annual convention in Houston, Texas. I'm part of the local board for NAREB. This was not a NAREB sales pitch. Whether you join or not, it's up to you, completely up to you. But every time I go to these annual conferences, they are completely life-changing. You learn something new that you can specifically implement within your business, or something new that's happening within the organization that you see that they're doing to help us within our businesses, as well as realtors, minorities, Blacks, Hispanics as well, to be able to continue to provide home ownership for people. So some of the things are some of the highlights from the convention that I was at was things like, they're talking to FHA, going to the actual FHA office. So the Secretary of HUD, which is Housing and Urban Development, is a Black woman, Marsha Fudge. The president of Ginnie Mae, which is Ginnie Mae, encompasses specifically VA, USDA, and FHA loans, is also a Black woman. And the president of FHFA, which is Florida Housing Finance Administration, which covers conventional loans, Freddie Mac and Fannie Mae, is also a Black woman. So these people are in positions of power doing things to kind of help push the agenda here, right? So things like having FHA lower the appraisal, sticking for 6 months. We saw that they recently passed that guideline. And NAREB is trying to get them to follow suit with the GSEs, where there is no appraisals being stuck on these properties, right? To be able to help maybe another FHA loan, if that appraisal does come in lower, another FHA loan come in and still be able to do an appraisal and still be able to be offered that chance to purchase that home, right? Which is a big, big thing, especially when we're trying to combat appraisal bias already on a national level, right? Something else, the self-sufficiency test, having overrides for 3 to 4 unit homes, specifically for first-time home buyers. So for those of you guys who don't know what the self-sufficiency test is if you're purchasing an FHA home that is a triplex or a quadplex, not a duplex, it's a multifamily that's a triplex or a quadplex. One of the qualifications is based on the property, where that property has to be able to rent out for the same amount as what the mortgage is. It's almost like a debt service coverage ratio on that FHA loan. So you have to qualify for it financially, but also those rents have to be the same amount as what that mortgage is. And we know with higher interest rates, higher affordability, that becomes much, much tougher to be able to do. So NAREB proposed directly to FHA to remove that override for first-time home buyers specifically. They've already responded to NAREB. They said it may not be specifically overridden for first-time home buyers, but they do agree that self-sufficiency test needs to be tweaked. And so they'll be working on that specifically with the mortgage committee of NAREB on the national level to figure out what kind of alternatives, whether that be DTI limits, whether that be down payment or anything, or any sort of other reserve or any other compensating factors is what we would call them, right? And then also, it doesn't pertain to Florida specifically, but it would help homeowners in community states. So in a community property state, states like Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin, I don't know if you guys know this, but the homeowner has to qualify for the mortgage with your spouse's debt included, even if the spouse isn't on the mortgage. So in Florida, if you're married and there's only one of us on the one of you on the application, we're only using your credit, income, and assets for that specific person. In these community property states, it's the opposite. It doesn't matter if that person's on the application. We have to use those spouses' debts in order to help with qualification. And it's funny because the vice president called it the anti-marriage guideline, right? Which is it's kind of true, right? What's the point of getting married at that point? But he also mentioned that it's a fair housing issue, which is also true, because technically someone cannot be denied based on familial status, right? You can't be denied just because you are married to someone. And in that case, that guideline does kind of intertwine into that. So the needle is being moved nationally to help us be able to qualify clients easier. Some recent things that have been done that do affect us today, before 2020, for those of you that kind of remember at that time, it wasn't that long ago, but it feels like forever ago at this point. But FHA's guideline for student loans was 1%, no matter if they had an income-driven repayment plan or not. Did not matter, right? We had to hit for 1%. So we know that the people that take out student loans are low to moderate income people, specifically minorities. And so that guideline was really affecting a lot of people trying to be able to purchase their first homes, right? So they got FHA to lower it down to 0.5%, or use that income-driven repayment plan if they had one. Okay, that was specifically through NAREB. The other thing as well, earlier this year, we got mortgage insurance lowered from 0.85% to 0.55% on FHA loans, which helps alleviate an extra $150, $200 a month for people that are using, or home buyers that are using FHA loans. That was also directly influenced by NAREB. So a lot of things that are happening on the national yeah, I got you, Dr. Carla. A lot of things that are happening on the national level really pertain to our businesses on everyday basis. And it's really important for you guys, I think, once in your career, just one time, go to one of these conferences, specifically that is hosted by NAREB, and tell me it doesn't change your life. Dr. Carla wanted me to repeat the first thing he said about FHA appraisal. So NAREB is working directly with FHA to remove the 6 months with the appraisal sticking. So right now, which is passed late last year, I think in December, right now, if you getting an FHA loan and you do an appraisal on that property and that appraisal comes in below value, right, and that seller doesn't want to negotiate for whatever reason, that appraisal is going to stick on that property for 6 months, no matter if it's a new buyer or anything like that. So what typically happens is those listing agents now, they're not going to take another FHA loan. They're going to go directly to conventional anyway, because conventional, they're going to want to get that appraisal redone. So if we're able to remove those 6 months of appraisal sticking, you don't have that where the listing agent's now forced to be able to pick a conventional loan as opposed to taking on another FHA, because that appraisal stuck to the property. So FHA and NAREB are working together to figure out how they can kind of alleviate that appraisal sticking. But to jump into the news for last week and why rates have kind of really fluctuated heavily. The credit rating decrease in the U.S. is because of the credit rating decrease in the U.S. last week. So Fitch, which is a credit rating agency, basically said that the U.S.'s credit is not as good as it used to be. Right, it went from AAA to AA plus. So what that means is essentially they're saying that FHA looks like, or not FHA, well, the government may have some trouble paying down their debts. Right, because they're increasing their debt ceiling, they're taking on more debt, but the amount of income that they're making is not increasing, and not income in the sense of creating money, right? No, like literally the actual cash flow that you're bringing in, your income is not increasing, but your debt is. So what happens? You go from a 760 to a 700, you're probably not going to get a lot as many offers for credit as you would, right? It's the same thing. So the bond market, U.S. Treasuries shot up because the U.S. Treasury is basically buying U.S. debt, right? Because the U.S. always repays its debt. When your credit rating gets decreased, now you have that fear. And so we saw the US bond markets spike up heavily because of that. I don't believe it's long term. I don't. I thought already by this time we would see rates kind of steadily dipping, and they're increasing. But it's because of two completely separate things, right? We called inflation coming down at this point. We were pretty much right on the money. We said June, July for a year, and we got that. Now it's other things that's happening that we didn't account for, which is fine. It's normal. It's kind of the adjustment. But I think the good thing is that ultimately the real fear-based things, which is employment, is starting to alleviate a little bit. And with inflation coming down, it's pretty much a matter of time before rates start to dip down as well. We may not see the fives by the end of this year like I originally thought, but we may be in the mid to low sixes comfortably. I don't think we're going to be in the high sevens for a long time. Looking at the bond market specifically, and I showed you guys this a couple of weeks ago, where the high that we've seen all through this last year and a half was at 4.20 was the 10-year treasury. Right now we're at 4.08. We tested 4.2 last week and it didn't break through. So that 4.2 is typically where rates were last year, about close to 8%. I think the national average was like 7.875 at that time, which was like September, October. That's where it was last week. It kind of dipped back down to about 4.08 this morning. And as we continue to get more bad news within the market in terms of employment, unfortunately, and in terms of inflation coming down, we'll see rates continue to come down. But it is a short-term pain because you're going to have people kind of pull back in the market a little bit for these next couple of weeks until we start to see rates get back into the low sevens again. Also not helping with bonds was the ADP employment report for July that showed that there were 324,000 jobs created, higher than the 190,000 that was expected. The Bureau of Labor Statistics also stated that there were only 194,000 private sector jobs. So one of them are lying, whether it's the Bureau of Labor Statistics or ADP, one of them is lying here. And hopefully it's ADP, because that increase of 324,000 jobs doesn't do too well for mortgages, right? Or within the current economy, because you're seeing things are, Fed rate is increasing, but jobs haven't broken yet. We need jobs to break. I've said this multiple times, and hopefully, and not hopefully, they do soon. Hopefully in the sense that it helps with interest rates, but not hopefully because obviously we're going to have a bigger crisis on our hands. Within the Bureau of Labor Statistics report, and I'm going to go into this in depth because this report came out a day after the ADP one, and it helped rates a bit on Friday kind of go back up or go back down a little bit. But it showed that within the report, part-time workers increased 972,000 and full-time workers fell 585,000. Multiple job holders increased by 118,000. So this tells us that the job market is weakening, which is a good sign in the long run for mortgage rates, because you're having to pick up multiple jobs in order to keep up your lifestyle, pay your bills, things like that, right? 112,000 people picking up multiple jobs, or 118,000 people picking up multiple jobs in a month is a lot, even considering nationally. The last thing that I kind of want to go over is something that we are seeing a lot of on these FHA down payment assistance loans, specifically through Hometown Heroes, Florida Bond, and even sometimes through the city and county loans that we're doing, is these borrowers that are at 640 or below, even though Hometown Heroes is specifically stating, hey, you need a minimum FICO of 640 in order to qualify for this loan. Guys, remember, we still have to run the application, right? I still have to run DU and see if FHA is going to accept that loan. And what I'm seeing, and it's crazy to me that it's FHA specifically, especially after listening to Marcia Fudge speak in the convention, but FHA is requiring reserves from clients. And I'm not talking about 2 months. I'm not talking about having an extra $5,000 in your account. I'm seeing sometimes where this application doesn't run unless I show $20,000, $30,000 of assets, which means that what's the point of getting down payment assistance? You still have to show that you have these funds. And the even crazier part is that $20,000, $30,000 cannot come from a family member, okay, like a gift. If I run the application with $20,000 in assets, on some of these, I'll get the DU approval. As soon as I remove that $20,000 and put it as a gift, which is same thing, right? Technically, you're getting that money gifted. The application, I didn't change anything else. I just moved the $20,000 from one location to another to have it gifted as opposed to an asset. Application won't run. And I think it's because a lot of times this happened in 2020, not with down payment assistance specifically, but when a lot of people were doing refinances rate and term, right? You see the GSEs kind of pull back and say, whoa, there's a lot there. We're getting a lot of these loans in all at once. We need to tighten up our guidelines a little bit or tighten up our DU, our desktop underwriting run in order to be able to kind of slow down the influx of loans that we're getting specifically through the down payment assistance portals, because it's not just happening in Florida. Down payment assistance is happening very, very frequently across the US. In Texas, there's a lot of bond loans that are being done. I know that specifically through the company, but it's very, very tough right now because this wasn't happening 6 months ago, 12 months ago. We were running Florida bond hometown heroes, 640 credit score, get that 10,000, 15,000, you were good to go. I think as of recently, because there's been such an influx of these loans kind of coming in through the pipeline, FHA has tightened up that DU, that desktop underwriting. And it may be for a short period of time, maybe for an extended period of time. We don't know, but I want to give you guys that heads up because sometimes what I'm doing too, and Destiana's in here, and it happened with some of her clients that we're still trying to figure out how to get these to work. Is we're trying to get that rescore done to 640, 660, right? If you come in at a 600, 620, I'm going to try to get the rescore done to see if you qualify for Hometown Heroes. But I can't run the application. I can't run DU until I get that 640 or 660. So when I get the 640 or 660, then if the application doesn't run, because typically it's happening with one person on the application, now we have another issue, right? This client spent $500, $600, $700 paying down their debt, thinking that it would work, and it doesn't. Now we have to add somebody. We have to find out they have 401k and stuff like that. The score that I'm seeing, the reserve contingency removed, is typically if we have two borrowers on the application, usually helps, even if they're both 640. Sometimes, not all the time. And then usually if you're at about 680, 700, you're not seeing that happen. But yeah, it's been tough for single people that are 640 trying to get that FHA loan to run. It's asking for reserves. What has been good news is that conventional has actually been much friendlier, especially Freddie Mac, for lower credit borrowers that are first-time home buyers getting down payment assistance that are specifically below the area median income, from what I'm seeing. So people that are making less than $70,000 a year, you're at 660, 680. And you're getting down payment assistance. A lot of times Freddie Mac is running for that client. So we're trying to look at both options, but just to keep you guys aware that the guidelines specifically for FHA are tightening a little bit, at least from what I see. And hopefully that doesn't happen for too long. You guys have any questions? Nothing? Any input? Any scenarios that you guys had last week that you would actually want to share with the other realtors in here to make sure that they don't go through the same thing, or how they can overcome it? Nothing? We're good? It is 10:22, so we're pretty much good, really good on time for today. Either way, next week, I think I do have a presentation for you guys. We can either do condo financing, because I already did mortgage 101 and pre-foreclosure. So we can do condo financing. I'll look and see. I have so many questions, I just don't know where to start. Just ask me one, Darlene. Yeah, the funds may be out by the end of August, Dr.
Yeah.
Carla. That is
And
true.
I probably
That is true because they're going by so fast. But think about that on the back end part of it, right? At your FHA, you're getting an influx of these down payment assistance loans, coming in through your pipeline that you're purchasing as HUD, and you're saying, wait, hold on a minute, we got to kind of slow these down, and they're going to tweak their desktop underwriting runs in order to do that. Darlene, you good? How do we get a list of tax lien properties? I have a client asking for it. Ooh. Hopefully, can a realtor in here answer that question? I would say Miami-Dade County property search, but I don't know if there's a better way to look for it. Look, Realty Track, IMAP. Hey, Felicia, I didn't know you were in here. It's been a while since you've been in here. How you doing? All right, if you guys don't have any other questions, I'll see you guys next Monday. All right, have a good one.
Thanks, Mike.
No problem.
Bye-bye.
Bye.
Great information. Claudia in here.
Hey, Claudiane, thank you for stopping by.